Hello traders, you're welcome back to the Forex Geek channel. And as usual, in this channel we simplify Forex strategies basically, and we provide actionable insights and help you to become a more confident trader. Okay, so this channel is for you. All right, you that is watching right now, this channel is for you. Okay. Now, in this particular video, we are going to be diving into one of the most fascinating approaches in trading, and that is none other than the double down trading strategy. So I don't know if you're familiar with this concept before, but it doesn't matter whether you're familiar with it before or not. I'm sure that there is something that you have to learn from this video today. Okay, it is the double down trading strategy. This is what we're going to be talking about in this video. Okay, I'm just going to edit this strategy right now. By the end of this video, you'll know exactly how to use these methods to enhance your trading decisions, to manage risks effectively, and spot high potential opportunities. Okay, so let us get started. Now, the double down trading strategy is all about strategically increasing your position size under certain conditions. Okay, now before you think this is just about chasing losses, let me clarify, it is not. Okay, this is a calculated approach where you are adding to your position when the market aligns with your analysis. Okay, it's not out of desperation. The key here is discipline and precision. All right, now you'll learn how to time your entries, combine this with technical analysis, and manage your risks like a pro. Sound good? Great. Let us break it down step by step. Now, timing is everything in trading. All right, timing is everything in trading, and the same goes for this strategy. The double down trading strategy works best when you have identified strong market trends. Okay, now in terms of identifying strong market trends, you can actually decide to use moving averages and trend lines. So I'm just going to add a moving average to the chart right now, and I'm also going to plot trend lines. So for example, here we can see that we had a valid bearish trend, right? You can see that we had a valid bearish trend around here. The moving averages show us that this is a sell trend, and we can see that with the aid of the trend line, with the aid of the trend lines, we have been able to identify this as a bearish trend. All right, so you can see how the price was making consistent lower highs and lower lows, right? Quite obvious on the chart. Okay, now we're just going to look for another example. You can see here again we had consistent lower highs and lower lows. That is from the trend lines. You see the trend lines gave us the trend direction. In addition to that, you can see that the moving average shows us that this is a clear bearish trend. Right? Now let us see if we can find a strong bullish trend as well. Let's say I find a strong bullish trend as well. Okay, we can see here we actually had a bullish trend, right? Although this was a gentle one, you can see that the slope was quite gentle. Yeah, but the main thing is that it is a bullish trend. You can see marked by higher highs and higher lows. You can see we had consistent higher highs and higher lows. All right, so this is a bullish trend as well. All right, let's see. Okay, now this one had This one had more swings, right? This one had more swings, but you can see it's a bullish trend. So basically, I'm just showing different examples, right? Different examples of, a bullish trend or a bearish trend, because that is the first thing that you need to identify, and it is very important. You need to identify the market trend. Now, after doing that, the second thing to do is to identify pullbacks within trends. Okay, so you spot opportunities where price retraces. For example, within this trend, you can see we had a pullback here, we had a pullback here. Yeah, this was a little pullback though, but it wasn't that much. Yeah, so you can decide to focus more on the pullbacks that get towards the support, right? So that you can have, more pips when the impulse move resumes, right? Because if you had entered the buy here, for example, you're going to have a smaller number of pips, because obviously the price is going to get rejected at the resistance, because this is a bullish trend, right? And you're still going to have pullbacks. But in the case of, entering a buy around the support, you can have more number of pips as the price would tend towards the resistance. Okay, now let's just look at a sell example, just a single sell example. All right, so we wait for pullbacks, right? So this is the direction of the trend, so this is the impulse move, and this is the corrective move. So the pullback is this. So right after the pullback, then you can enter a sell, look for sell opportunities. Right after the pullback, you can look for sell opportunities. Okay, and then you also need to identify support and resistance levels. Okay, look for areas where the market is likely to react. So in addition to these dynamic levels, that is the dynamic support and resistance levels bound by the trend lines, you can also pay attention to the horizontal levels as well. Okay, identify horizontal support and resistance levels, areas where the price is likely to get rejected. Okay, so just try as much as possible to identify important resistance and support levels where you had multiple rejections in the past. Okay, because those levels can also give you ideas as to possible reversal zones in the future. Okay, so remember, it's not just about doubling your position arbitrarily. You are doubling down when your analysis strongly supports the move. Okay, for example, this is the Euro USD chart. Okay, so currently the Euro USD is consolidating, right? This is current price activity. As you can see, this is current price activity. So currently it is consolidating. So I'm just going to use, I'm going to use a historical example, right? So now let us say that Euro USD is in a strong uptrend, right? So after a pullback to a key support level, for example here, right? And your indicators confirm that the price is likely to rebound. For example, what happened around here, because the moving average is serving as a dynamic support and resistance level as well. So the moving average actually confirmed that the bullish move is going to continue, because you can see the price climbed above it and it even retested it. So this was a confirmation, right? Now this is where doubling down can amplify your position strategically. All right, so let us talk about risk management, which is the cornerstone of this strategy. Okay, because without it, doubling down could lead to significant losses. So here are a few key points to keep in mind. Okay, the first is to set clear stop loss levels. All right, always know where you are cutting your losses. For example, if you decide to enter a buy trade around here, you can decide to set your stop loss for the fact that this trading channel, this trading channel is quite narrow, right? So if you are entering a buy here, setting your stop loss here is going to give you a poor risk to reward ratio. Okay, because your target profit is going to be somewhere around here. So in that case, you might be having roughly 1 to 1 risk to reward ratio, or maybe a little more than that, but less than 1 to 2. So instead of setting your stop loss all the way here, you can confirm the continuation, because the moving average here has already told you that the bullish continuation is going to occur. Reason being that it has broken above, the price has broken above the moving average and we tested it and started going back upwards. So this would have been a good place to enter a buy right at the close of this candle. So after entering a buy, you can set your stop loss just below this. So in that case, you'll be risking about 230 pips to make somewhere around 200 and somewhere around 49